This question is from Matt C. He says, with a low rate on the mortgage, what are the best options for funding improvement of our current home to accommodate a growing family? He's thinking of doing this versus buying a new home at a higher interest rate, which, then maybe it wouldn't be in that 25% of the gross income range that we talk about.
Yeah, my wife and I, we've had some of these same conversations, right? One of the things that's really, really interesting, was it you who told me this stat, Brian, that right now, 99% of homeowners have a current mortgage rate lower than the current rate.
Yep.
99% of homeowners. That's mind-boggling. Well, in my mind, what that tells me is the ability to move is going to be difficult, right? A lot of people are going to say, man, I've got this mortgage at 2.25%, 3.25%, 3.5%, 4%. No way am I going to move into a new home, because then I got to, I lose that good mortgage and now I'm up at this. And so some people say, well, I'm just going to improve my current house. Well, if I don't have cash to do that, I got to find a way to borrow money, or I need to save up to do that. It is hard because, again, I have a good friend right now. He's about to do some big improvements at his house. He just got quoted for a home equity line, right? He's going to, borrow against the equity he has in his current home, but it was prime plus 0. So I want to say it was like 7%, 7.2%. So if I am someone thinking about doing improvements, how creative should I be? I mean, obviously there's saving cash, right? Like I just save up, pay for it in cash. I could take out a home equity line. I could borrow against the cost of my current home. I could probably do like a mortgage, a margin loan if I have a brokerage account and I didn't want to liquidate brokerage assets. I mean, what's the answer here? What's the thing that people should think about when it comes to improvements? And is your answer, Brian, with that, are all improvements created equal? Right.
Well, you totally read my mind, because I wrote down 3 quick things, and I'll just go ahead and tell you these 3, and then I'll get into each one. I put the what, which is what are you improving? Like, because we know historically kitchens are a good investment, master bathrooms and things like that are closets. Those are positive things. And I would also, the what, make sure when you do improvements that you don't give yourself some false sense that when you put the fancy, I'll give you a perfect example. We're looking at redoing our master bathroom. And I remember when we built our house, my wife had to have these bump outs for the master bath, and then these furniture legs at the bottom of the thing. And then now that she's talking to these tradespeople, and she's like, no, we got to replace all the cabinets. And I'm like,
we did the bump outs with the legs.
Yeah, I was like,
we
we can't just paint them. I mean, because we have all, and then find out, no, the new style is flat is good. It's
so you mean styles change over time.
Styles change. So whenever you do a project, make sure that you're not putting something so custom or or trendy that you lose that value, because that's something that I think a lot of us fall prey to when you're redoing. You make sure it has some market value to the masses, not just so personalized to you. Because I've seen some of the houses in our neighborhood that have sat the longest were the most customized to what,
like every wall had a special wall.
Yeah, they were just different, and so people, when they came in, they couldn't put their own vision to what it was. So the what matters a lot. Don't go spend money on stuff that's not going to have value for you. The second is the timeline. I would tell you, if you're thinking about how I'm going to pay for this, go ahead and create the timeline of how long will you get benefit from this if you're going to be in the house long term, but also when knowing your income, your cash flow situation, is this, while we're in this high interest rate environment right now, that you could pay this off in 3 years if you could cash flow it, or 5 years? What's the timeline? Figure that out, because I think that's important, because then once you know the what, and you're measuring twice on, am I actually going to get long-term value out of this? You then think about the timeline of how fast you could pay this off. You can then move to the product or the ability to do this. And that's where you can consider a home equity line, a home equity loan. You can consider, different ways to, margin loans. There's ways, or just straight up cash flow. You wait a year and a half to do it, because you're going to, save up enough cash to do it. Once you have those first 2 questions answered, I think you can move into step 3, which is, if you can pay it off fast enough, the higher interest rate on some of the loans might not hurt you as much, because you're paying it off within 24 months. But it also might lead you to say, hey, well, heck, if I can save this much money, can I pay for it as we go?
There we go. That's
by just cash
solution.
flowing it. All that needs to go into consideration.